Ever wondered why some options are cheap while others are expensive? Or how traders figure out the fair price of an option? Today we are going to dive into Black Scholes model, a total game changer in option trading. And don't worry, I'll make it so simple that even a 5-year cricket fan can understand it. The Black Scholes formula was developed by Fisher Black, Myron Scholes in 1973, with a major contribution from Robert Merton. In 1997, two of them were awarded with a Nobel Prize in Economics for this revolutionary work in the option pricing theory. Now, why we should care? Because this is the same formula used by NSE to price the options in India and also used by most of the global exchanges. This formula is important because it brings objectivity to trading. Now here is the best part. You don't need to memorize this formula, but understanding how it works gives you a massive edge. Think of a cricket match. The final scores depend on pitch condition, weather, form of a player, etc. Similarly, in option trading, Black Scholes model acts as a mathematical pitch, helping us to estimate the fair value of an option. Here is what you need to feed into the model. Number 1, stock price. Number 2, strike price. Number 3, time to expiration. Number 4, interest rate. Number 5, dividend. So the model crunches all these and gives you implied volatility. But wait, it gets more interesting. You can also reverse engineer the formula. If you already know the implied volatility, you can calculate the exact expected value of an option price. Professional traders don't just look at the option price. They watch the implied volatility like a hawk. Why? Because when options are mispriced, it creates an opportunity. It's like batsman reading the bowler's wrist position to guess the delivery before it's balled. Here is how traders create an edge. If the volatility is underestimate, they buy the option. If it is overestimate, they sell the option. That's how we build our positive expected value into our trades. So next time you see an option premium, don't just ask is it high or is it low. Ask what is the implied volatility, tell me. That's where the real opportunity lies. Let's lock our learning with these 5 questions. Question number 1. What is the primary purpose of Black Scholes model in option trading? A. To predict the exact price of the underlying stock. B. To determine the implied volatility of an option. C. To predict the market trends. Or is it D. To calculate the interest rate? The answer is B. To determine the implied volatility of an option. Question number 2. Which of these following inputs is not used in Black Scholes model? A. Strike price. B. Stock price. C. Days to expiration. Or is it D. Stock's dividend payout ratio? The answer is D. Stock's dividend payout ratio. Question number 3. What does implied volatility represent in option pricing? A. The volatility of the stock price over the past year. B. The amount of risk involved in the option price movement. C. The market's estimate of a stock's future volatility. Or is it D. The historical performance of the underlying stock? The answer is, you guessed it correctly, it's C. The market's estimate of the stock's future volatility. Question number 4. If the implied volatility increases, what happens to the price of an option? A. The option price decreases. B. The option price stays the same. C. The option price increases. Or is it D. The option price fluctuates randomly? The answer is C. The option price will increase. Question number 5. In Black Scholes model, if you expect higher future volatility, then what is the implied by the market? What should you do? A. Buy the option. B. Sell the option. C. Avoid trading the option. Or is it D. Ignore implied volatility? The answer is A. Buy the option. Share your quiz score in the comment. I'll personally review it and guide you on what to learn next. If this video simplified the Black Scholes model for you, do share it with someone who finds the pricing confusing. In our next lesson, we are going to explore mean, median, and mode in option trading. Until then, keep learning and keep winning.